All right, I see some of you guys joining the stream. You are welcome back once again to this live session. So, as you can see on the screen, we are going to discuss a part discussion on accruals and prepayments as one of the key concepts in accounting. So, once you get these fundamentals with your recording, you should be able to actually record all transactions so far as your double entry principles are concerned. So, you are welcome back once again. So, if you just join us, please make sure to give this video a like, share with your friends that we are live so that they can also join us in that case. So let's keep on sharing this video so that others can join us in that case, in that live. So you are welcome back once again. So consider to like this video and share with your friends so that we get much engaged. So we are going to start very soon. So share this video so that others can join in that case. All right. So let's start real quick in that case. Let's start real quick. So let me get my setup so that we start real quick in that case. So let's share this video so that others can join in that case. All right, so let's start. Get my board here. So let's invite others that we have online so we get started very soon. So let's see. So if you just join us, you're welcome back once again to this live session. So let's start real quick in that case. So there is a question actually. The following balances were extracted from the ledgers of Padisco Limited. Padisco Limited. Padisco Limited. All right. So we have on 1st October, and we have what 31st of September. So even before we get excited about this question, one thing that we need to understand when it comes to accruals and prepayments, as I said earlier on, it forms the basis of your double entry recording. It forms the basis of your double entry recording. So once you get this concept right, you should be able to record transactions as and when they occur. What do you mean by accruals? What do you mean by prepayment? Let's say we have two parties in a transaction. You have part A and what? Party what? B. I hope that is clear. So at this point, let's say part A, for instance, let's say part A provides services to what? Part B. Services. Services to what? Part B. What happens here is that if let's say at the end of the day, part A, let's say provide service to party B, but then party B has enjoyed the service from A, but the party B hasn't paid the amount that is party A is due or entitled to, that amount that party B hasn't paid at the end of the accounting period, we call it what? Accruals. So once you heard of accruals, we are talking about what? An amount that is owing by another party. So in this case, party B owns what? Party A. I believe that is clear. So that is a concept about accruals. So it can be in the form of what? Owings. So owings, it can be in the form of where one owes another. It can be a liability. It can also be what? An income. So how then it becomes an income? Let's say part A. In this case, let's say once you provide what? A service to party B. To party B, it becomes what? An expense that he owes. It becomes what? An owing to party B. But to part A, it becomes a form of what? Revenue that he entitles to. So in that case, we call that revenue that part A is entitled to as what? An amount that is what? Due part A, or an amount that is receivable from what? Part B. That is due part what? A. But to part B, it becomes what? A liability to what? To part B. So accruals can actually be in the form of what? A revenue, or in the form of what? A liability. So that's how the concept works. So once you hear of accruals, you're talking about owings. Owings, an amount that one party owes another. That is accruals. When it comes to prepayment, prepayment has to do with where a business entity will pay certain amount of money in the future for which they haven't enjoyed the benefit or the service what now. So the benefit of that payment is going to be received in future. That's what we call it prepayment. So in this case, if let's say part B let's say party B pays what, an amount of, let's say, 500 Ghana cedis to party A, but party A hasn't rendered the amount or that service to party B. That means that 500 here that you are seeing here becomes what, prepayment, for which party B is entitled to what, the benefit of the service in future. That's what we call what, prepayment. I hope that is clear. So that's the issue about prepayment and what, that of what, accruals. So once you hear of prepayment, you are thinking about what, benefit that the one who pays that amount is entitled to in the future. Is that okay? But won't enjoy it now. But accruals is basically the services that one party has enjoyed, for which he's entitled to pay, or for which the one who rendered the services is entitled to receive what, that money from the one who have enjoyed what, that service. So to the one who enjoyed the service becomes what, an expense or a liability to what, the one who enjoyed the service, and then to one who is to receive the service that provide in terms of what, monetary value, becomes what, an income that he or she is entitled to. So that is the issue about what, prepayment and then accruals. I believe that is clear. So if you just join us, you are welcome back to this live session. Please consider to share this video out so that others can join us in that case. So let's begin real quick with the, so that was just by the way. That was just by the way. That was just by the way. So let's see how we can answer these questions in that case. Let's see how we can answer these questions. So these are the balances extracted from the ledgers of Padisco Limited. Padisco Limited. So we have on 1st October, we have 20x5, we have what, 30th September 2, we have what, 20s6. So meaning that the accounting period for Padisco started in what, 1 year and ended in what, another year. So that is the issue about what, their accounting periods. I hope that is clear. So that's the issue that we need to understand at this point. So it starts on 1st October and ends on 30th September in another what, year. All right. So here we have rent receivable in the form of what, prepayment. We have rate. So these are the balances. These are the opening balances and closing balances for Padisco what, Limited. These are the opening balances and closing balance for what, Padisco Limited. And during the year, let's see something here. During the year ended 30th September 20x6, the following transaction took place. So for the year ended 30th September, we have this transaction that took place. We have for trends received by check, rates paid by check, insurance paid by check. We have check receipts from trade debtors. We have discounts allowed to trade debtors. We have bad debts written off, and then we have payment to our suppliers of our stationery. So the requirement here is that we are required to post and balance the following ledger account for the year ended 30th September 20x6 and show clearly the amount to be transferred to profit and loss where applicable. So these are the accounts that we are asked to prepare. So as I said earlier, once you get this fundamental, once you get this concept, your base of recording in terms of double entry, you become what, fine with it. So these are very key things that we need to know when it comes to recording and then double entry in terms of our transactions. So we have to prepare an account for what, rent receivables, B, rate and insurance, C, trade debtors, and D, stationery. Please just join us. You're welcome back to this live session. Please consider to share this video with everyone who may be interested in this kind of what, lessons. Is that okay? So that we all learn in that case. So let's keep sharing in that light. So let's get started with it. So here is all about what, our double entry: debit the receiver, credit the giver. Debit the receiver, credit the giver. Is that okay? So any party who actually gives is going to what, credited. The one who is receiving, as I already indicated, when it comes to the double entry, you assume that we have human beings that are into what, into play, and then they are exchanging what, transactions, where one is giving, another is what, receiving. Is that okay? So that is the concept going to apply: debit the receiver, credit the giver. So let's get it right away. So you're going to prepare an account for rent receivable, B, written insurance, D, trade debtors, and E, sorry, C is trade debtors, and D, stationery account. So let's see how we go through in the preparation of what, these accounts. In the preparation of what, these accounts. In the preparation of these accounts. Okay, give some few minutes and let me check up something here. So we start right away. Continue right away, sorry. All right, so let's continue in that case. Let's continue. So you're asked to prepare what? Rent receivable. What is rent receivable? We'll get to know the meaning of rent receivable as we enter the items in the account in there. All right, I'm coming. So we continue in that case. So if you're online, please share this video with everyone. Share this video with as many students as possible so we can assist many students to better themselves when it comes to financial accounting in that case. So let's share this video out so that others can join in that case. All right. All right. So let's start right away. Let's continue right away in that case. I was just to push something out so that we get it done in that case. All right. So let's take the first word. Account. So we are asked to prepare what? Rent receivable. So all information about rent receivable that was provided in this question, that's what we're going to use to record this transaction. Is that okay? So let's have our rent account shown here. So A. Oh, come on. My board. So let me share my board once again here. It seems kind of coming. So we continue in that case. So you can see the board. Oh, come on. All right. So I think now you can see everything right away. So let's start with what? Rent receivable. Rent receivable. So you're gonna have our rent receivable as A here. So rent receivable. So you're going to use what? A T account to actually record what? This transfer. So rent receivable. You have your T account. Sorry. You're gonna have your T account. So oh, this is something. You're gonna have your T account. So with a T account, on the where I'm positioned now, I can say that on the left hand side can be my debit. So I'm going to have here recorded as well my currency, I think it was in Ghana cedis, so recorded as what Ghana cedis, or let's see the currency. Yeah, in Ghana cedis, right? So that is what we need to know. So we start with rent receivable. So let's see the information about rent receivable. So you see you have an information about rent receivable here. Is that okay? So that is the information about rent what receivable. The first item I've taken information about rent receivable is there. So you're gonna pick those information then use to what to record. Remember when we started our accounting year or accounting period on 1st October 20S5. As I said earlier on, the business Padisco business start 8 accounting period in 1 year and ended in what another what year in 1 year and ended in another year. So here, as you can see, it started on 1st October 20x5 and ended on 30th September 20x6. So let's see. We have rent receivables prepayment. So meaning that here is a case where once you get a rent receivable is what a source of what income towards Padisco Limited. So in this case, Padisco rent out some of what is space to other people. So if there is rent receivables that Padisco has received, but for which those tenants involved haven't what actually come to occupy what those what those houses or whatever that you rent, is that okay? And you have made payment for it, it becomes what prepayment. So let's say Padisco Limited actually offer whatever that you rent it out to, let's say Part A. And at the end of the day, Part A have made what payment, more like payment in advance. Tenant, you have made payments in advance. Is that okay? So, but for which you haven't come to occupy the space that Padisco have what rented out to you, and you have made payment. That payment we call it what prepayment. But since Padisco is going to receive that money in the form of what income, you are going to call it what rent receivable. So in this case, it is a tenant that pays to what Padisco. So if that is the case, then this rent receivable that you see prepayment here to Padisco, it becomes a liability to Padisco. But then to the tenant, it becomes what an asset to that tenant, more like what a current what asset. So in this case, this 800 that you see here is an asset towards party A, but then a liability towards Padisco Limited, because he's here towards the tenant is here to occupy what that space that you have let it out to part A. So to Padisco becomes what a liability. So we said that all liabilities have what a credit what balance. So the balancing figure that you see as an opening balance for rent receivable is going to be at the credit side. It's going to be at the credit side of what rent receivable. So we're going to call it balance what brought down, because we actually brought this balance from the previous year. So balance what brought down. By conversion, you can write in this form balance brought down, and the figure was what 800 Ghana cedis, and you record it. I believe that is clear. So here we can clearly see that the rent receivable is more like what an income. It's more like an income. It represents more like what an income account to. That's done on behalf of what Padisco Limited. I hope that is clear. All right. So once we get that, that is for what prepayment. That's for the prepayment on what 1st October. I hope that is clear up to this stage. I hope that is clear to this stage. And then as at 30th September, that's where the year ended. We also having what prepayment that tenant has made toward Padisco. So that one too, since we said is a liability towards Padisco Limited, since the tenants having come and occupy what that space or that service having provided by Padisco, is going to what a liability going to have a balance at what a credit side of what the account at the end of the day. So let's take note of that. Let's take note of that. So we come back to the 950 later on in that case. So that is for the opening balance 800. Now let's come and check during the year. Was there any payment for rent receivables that Padisco received from a tenant? Let's see. So that's the first statement. During the year and the 30th September 2006, the following transaction took place. Rent received by what? Rent received by check of what? 16,000. So here is a case where it is actually the tenant that are paying for what? The rent. So Padisco is receiving what? That money in the form of what? Check. So here we have two accounts that are involved. You want to have what? A cash book, or more like a bank account, because that tenant pays that amount to Padisco in the form of what? A check. So you're gonna have a bank account that will stand on behalf of Padisco. So that bank is going to receive that 16,000 that was paid as what? Rent for on behalf of Padisco. And then when you go to the rent receivable account, that stands for more like what? The account for what? The tenant. More like an income to also to the Padisco is going to what? Credited. Since that rent receivable stand for the tenant. Is that okay? So once they pay for it, the double entry is saying that credit what? The giver. So here it is the tenant that is paying the amount to Padisco. So you're going to credit what? Rent receivables account for the tenant. But then this amount is going to be recorded as a debit balance in the bank account in the name on behalf of what? Padisco Limited. I hope that is clear. I hope that so at this point we can say the 16,000 going to be recorded here at the credit side as bank, right? And then it records as well 16,000. And when you go to bank account, you record it as what? Rent receivable at the debit side of what? Bank account. So because since the tenant pays for it, he paid in the form of a check. So it's going to be actually reflected in the bank account as well debit on behalf of what? The Padisco. But actually, when the bank engage in the transaction with Padisco account on the bank, going to be at the credit side. That one is going to be done by the bank. But here we are interested on how this transaction is going to be affected. That of the rent receivable, that's down for the tenant, and that of what? Padisco bank account. In that case, that's why we are actually interested. So we are not opening any account for what? Bank. So we are just interested in recording. So since the tenant pays for that 16,000 and rent receivable stand for the tenant, more like an income towards Padisco is going to be at the credit side as well 16,000. I believe that is clear at this point. All right. So once you're able to get that, that is the amount that they paid during the year. Is there any amount that they paid during the year? Let's see. Rate. The rate is not part of rent receivables. Insurance. We have check received from what? Debtors. Okay, that we're going to be cater for in the debtors account, bad debt and others. So no other information. So once we are done with that, then we come back to 30th September. You realize that with 30th September, we're having what? Rent prepayment. On first, we have recorded that one as what? A balance brought down here on the as at what? 1st October 20 what? X5. And then as at the year and the 30th September, we also having what? A balance as at 30th September, and that was what? A prepayment. As I've already indicated, since it is a amount that tenant has paid for it, for which they haven't enjoyed the benefit, is going to be a liability to Padisco, but then to the tenant, so it becomes what? A current asset to those tenants involved. I'm using that scenarios or those two parts so that you get to understand how these transactions are treated. It's very important that you get those fundamentals. So at this point, we can say that please excuse me, let me put in my charger since my laptop is getting low so that we continue in that case. I'm coming. Let's get straight off. All right, so that was just by the way, having my charger be on my laptop was getting off. I didn't take a get off. So sorry for that in that case. So as I was saying, that's why we need to understand it. So at this point, since the 950's prepayment is going to be a liability for that of what? Padisco. So in the account of rent receivable, it's going to be, we said all liabilities have what? A credit what? Balance. So it's going to be a balance that we are going to use in the next accounting year. Is that okay? So we're going to have that balance here as what? 950, but I'm going to call it out as what? Balance what? Brought down. That's going to be an opening balance for the next accounting year. Since we have balance brought down as for 950 at the credit side here that you can see here, you're going to have it other side. We are having, so at the time you have balance brought down, there should be other side of what the recording as called balance what carry down. So these are the balance carry down going to be. So this, once you have this 950 at the credit side of what rent receivables, you're going to have it what other reflection to what balance brought down at the debit side of what rent receivables. So you're going to have here as what balance what, sorry, carry down, rather I mean carry down, balance carry down at the debit side of rent receivable, and that's going to what 950. That's going to be 950. This is not rent, but rather it's what rent receivable. So it's an account more like what a debtors account. Is that okay? It's a bit like more like a debtors account. So once that the debtor pays any amount, it's going to be at the credit side, right? So once the pay going to be at the credit side, and any other payment that he makes are going to reflect in other account for the company in that case. So fine. So once you have already recorded this, so that I think that is all. No other information that was actually mentioned in this case. So let's balance it off and then we are good to go. So at this point, you can clearly see that we have the credit side 800 and what 16,000. So when you add the two, you're gonna get what 16,800. So you can clearly see that the credit side of the receivable account is greater than what that of what the debit side. So the difference between the total of what the debit side and the total of the credit side is always going to be the amount you're going to send towards your profit and loss what account. I hope that is clear. So at this point here, since the credit side is greater than the debit side, it's going to what the difference is going to be. So you're going to have here, you realize that the credit side, the debit side of the rent receivable is what 950. So you're going to take the difference between what 16,800 and what 950. So let's see what you're going to get for this, and that's going to be a balance that's going to represent what our profit and loss account. That's going to be a balance that's going to represent our profit and loss what account in that case. So let's see. Let me grab my calculator here and then let's see how we can get a difference. So 16,800 minus what 950. 16,800 minus what 950. I had what 15,800 and what 50. So that's going to be our profit and loss. The figure going to send to our profit and loss going to be what 15,000 15,800 and what 50. So our P&L 15,800 and what 50. Is that okay? So we're going to close this account too. So we're going to have both sides balancing as what 16,800. You close it, 16,800, and then you close it. So this is how you balance an account. So at the end of the day, the balance carried down is going to be reflected at the credit side here, as you can see here as what balance brought down as what 950. So in the rent receivables account, we have what a balance of, so this balance here that you see here is going to send towards your statement of what financial position. That is your balance sheet, as you know in that case. And this amount that you see as P&L going to also to be in the profit and loss account as what rent receivables. So here, since at the debit side of rent receivable, when it goes to P and they're going to be at the credit side, more like what an income of what other incomes to the profit and loss. If let's say Padisco actually operates in other business, but since it's just the business is operating, that's going to be more like what is revenue at the end of the day, together with I think other trade debtors information going to work out as we move along. So that is how we calculate for, or that's how we prepare an account for what rent receivables in that case. Any questions so far? Any questions so far? Okay, let's see. I see some comment coming in here. Let me pick it up, then we continue in that case. Ijusu is saying that why is the 950 on both sides? Yes, 950 on the both side of the account because the 950 was what the closing balance for Padisco Limited. I hope that is clear. So at this point, once that is the closing balance for Padisco Limited, since it's a balance, closing balance for Padisco Limited, and it is prepayment, an amount that tenant has paid for which Padisco having rendered that service to them, is going to be a debit balance in the rent receivables as what balance carry down. At the end of the day, once you close your account, you bring it to the next period that's going to balance what brought down. That's why you see 950 as carried down, and then 950 as what brought down at the credit side. So that's the reason why we're having that. I don't know whether I've gotten the concept right. So if you have gotten, let me see in the comments if I've gotten it right, so that I'll know the way forward in that case. So let me share my screen once again. So that is why we are actually talking about the reason why we have here to be credit and then here to be what debit in that case. So let's take note of that. So let's move on to the next item. So the next item here is what B, rate and insurance. Rate and insurance. Rate and insurance. So let's here also prepare an account for rate and insurance in that case. Rate. So let me have that one here. Rate and insurance. Rate and insurance. Rate and insurance what account? Rate and insurance account. So that one to have your currencies indicated. Currencies indicated. Currencies indicated. So you follow the same thing. So first, let's see. So rate and insurance, you also having what prepayment for what rate and insurance. But remember, when insurance comes in, here is a case where the business want to insure, right? It's what assets that you use to what deal in a business. So the rate and insurance is an expense to what the business, an expense that they incur on regular basis with regards to their assets or with regards to the items that they use to run their business. More like those items that are of what long term in nature, like assets, like buildings that you have that you rent to what outsiders. You gotta make sure that you insure is that at the end of the day, let's say if there is any fire outbreak or anything that can cause you to lose all these kind of what assets that you have, or let's say there is a fire outbreak, at the end of the day, once you have insured the building, you can what claim for some what compensation or insurance for that. Is that okay? So that it can be recoverable to you. So the written insurance is an expense. Generally, it's an expense. So let's see how we treat or we record the information here as regards to rate and what insurance. So we're having on 1st October rate and insurance, we're having what a prepayment of what 5,000. We're having a prepayment of so this 5,000 that was an amount that was paid by what Padisco, right? For let's say the previous what year. But then Padisco haven't enjoyed the benefit of what this expense that it has paid for. Is that okay? So it becomes what prepayment. So once it is prepayment, in this case, since it's something that the business Padisco has paid for it, but for which they haven't enjoyed the benefit of it, it becomes what an asset to Padisco. But to those that we have paid, the insurance company, it becomes what a liability to the insurance company. We are not interested in the entries or the accounting treatment for the insurance company. We are interested in what happens in Padisco what Limited. That is our focus. I hope that is clear. So here, the written insurance that you see here is an expense that they have prepaid, right? That they have paid for, but for which they haven't enjoyed the benefit. They have paid for that expense, but they haven't enjoyed the benefit. So to Padisco Limited, it becomes what a current what asset. So we said all assets have what a debit balance in their account. All assets have a debit balance. So this rate and insurance figure that you see here as prepayment is going to be debited as what a balance brought down and going to be at the debit side of what rate and insurance. So straight away, you tell us that here our rates and insurance going to be a balance what. So balance that we have brought from previous period. So as balance what brought down. As balance brought down. Oh, come on. As balance what brought down, and that's going to what 5,000. That's going to 5,000 at the debit side of what rate and insurance. I hope that is clear. All right. So once you have that one there, then we come back to so here we're having what prepayment and what accruals. So we're gonna deal with them, especially those on what 1st October. That's the beginning of what the accounting year. So we're having prepayments of what 5,000, and then we're also having accruals. As I said earlier on, accruals are something that is owing by what a party in a transaction. Is that okay? So accruals here means that there were some services that Padisco enjoyed for which what they haven't what paid for it as at what the previous year, and then in the next accounting they need to what bring it forward so that they can account for it in that case. So this the service that Padisco have what enjoyed but for which they haven't paid for it, and it's an opening balance that's on 1st October 20x5. So here, since it's an amount that they have enjoyed already, but they haven't paid for it, it becomes a liability to what? Padisco Limited. So that 1,100, and we said since all liabilities would have a credit balance, going to be at the credit side of what? Rate and what? Insurance account as what balance what brought forward as balance brought. So here, gonna have here as what? Balance brought forward as what? Thousand, sorry, as thousand what? Oh, come on. Thousand what? 100. Thousand, oh, 1,100. So let me raise here so that we get it. So balance. So we're gonna have here to be, oh, come on. To be balanced, brought forward as what? 1,100, and you record it, and that is all. So once we are done with the information about the opening balance, with the closing balance, we will come back to it where we are done with the recording of all other information, so that we record that one as such in that case. So let's get back to during the year. What happened during the year? So during the year and the 30th September 20X, the following transaction took place. So let's see information that are relevant to rate and insurance. So we have one here, rate paid by check. Is that okay? You also have insurance paid by check. Is there any other information related to rate and insurance? So you have check received from, that's from debtors. Okay. So other information doesn't have any relation with what? Rate and insurance. So straight away, you're going to record it. So this were the amount that were paid by Padisco Limited for rate and that of what? Insurance. So it's an expense. So we said all expenses have what? A debit what? Balance. So we're going to record this at the debit side of the rate and insurance. But what means did we use to pay this expense? It was what? With through what? A check. So you're going to record as what? Bank. Because once we issue check, means that you are using what? You are using our bank account to make the payment. I hope that is clear. So here, straight away, we can say that you're gonna have what? Bank. You're gonna have bank account, and you have what? Rate, and you have what? Insurance. Insurance. So with rate we paid what? 40,000. Since expenses have a debit balance, that's why you're recording it as what? The debit side of what? The rate and insurance what account. So rate we paid how much? 40,000. So let's record 40,000. Is that okay? And that of insurance too, we paid how much? We paid 28. So we record that one to 28,000. I hope that is clear. So 28, you record that one as well, 28,000 in that case. So once we are done with this, then we move on to the closing. What was the closing balance? Was there any closing balance for rate and insurance? Yes, of course, there was a closing balance for prepayment as well as for the accrual. So you're having a prepayment of what? 2 times, having accruals of what? So at the end of the day, during the year end, we are having amount that we have prepaid for which you haven't enjoyed the benefits. So it becomes what? A current asset to Padisco Limited. But then you're also having some amount that we are owing for which you have enjoyed the benefit, but we haven't paid for it. So that becomes what? A liability to what? Padisco. So once an asset going to be at the debit side, once what? A liability is going to be at the credit side of the account in terms of what? Rent, rate, and what? Insurance. I believe that is clear. So here we're going to record what? 2,000 as what? Balance what? Brought down at the debit side of what? Rate and insurance. And then record what? 1,200 as on the credit side of rate and insurance, or as what? A liability that Padisco must settle in the future. I hope that is clear. So at this point, that's what you're going to do. That's what you're going to do. So you're going to have here. So you're going to have here debit side here. You're going to have here to be balance what brought down as what 2,000. Remember, once you have the balance brought down, you reflect the other. That's carried down as the opposite side of what the account. So balance brought down of 2,000 for that was what prepayment. That's the written insurance prepayment. So 2,000 you record it, and then you record your balance brought down to at the credit side. So you tell us that balance brought down as what 1,200 at the credit side, 1,200 at the credit side. That's for the accruals that have been paid. So once we have balance brought down for 2,000 at the debit side here, you're gonna have a balance here to be balance what carried down as what 2,000, and record that one there here. And for the liability too, 1,200, you also have that reflection as balance carried down at the debit side of what written insurance. So you're going to record that one too in that case. So you're going to have here to be balance carried down as what 1,200. So once you are done with the recording, that is all. The next thing you want to do is what balance what the account is to balance at the account. So in balancing of the account, this is what you do. You add all the debit side of what all the debit figures. I mean all the figures at the debit side. Also add all the items at the all the figures at the credit side, and you compare the two in terms of the total. The side which falls short, that's what we're going to add the difference to. And that difference is going to call what? Profit and loss. Going to call as what? Profit and loss in that case. So let's see. Let's see. So with my computation here, with my calculator, when I added all the debit side, I had a total of what? 74,200. 74,000. That's what I got for the debit side. But for the credit side too, I had, so credit side 1,100, and then that's of 2,000. Remember the balance brought downs aren't part of the calculation, so don't add those ones. So let me underline it to show that we are dealing with all totals. Is that okay? So that you don't add those figures in there, because you have already added it in terms of their carry down. So that is that. So the credit side too, you're gonna have what? 3,100. So you subtract 3,100, 3,100, subtract 3,100 from 70, from 74,200, 74,200, and the difference should fetch you. So you're gonna get 71,100, 71,100, and this difference is going to be placed at the, because it was the credit side that was shortened, right? And that difference is going to be placed at the credit side as what? Profit and what? Loss. So when you go to profit and loss account, since here has been credited, profit and loss is going to what? Debited as what? Rent, rate and insurance. That's the amount that we are sending to the profit and loss for rate and insurance at the end for the year end. I hope that is clear. So it's going to what? 71,000. 71,000. Let's see. 71,000 or 100. 71,100. Come on. 71,100. And then we are done for rate and insurance. So at this point, any questions so far? Any question? Any question? Please consider to share this video out, like, and then most importantly, always subscribe to the channel. Please subscribe to the channel. Okay, so once you go live or release any new video, you're able to get the update right away. And make sure once you subscribe, you turn the post notification on. If you haven't done that, please let's do that. Turn the notification, the post notification on, so that once you go live, you get the update. You see, once you subscribe, a bell will, pops up closer to the button. Just hit the bell and select all. That's what I mean. And then once you select all, any update or any notification that you post on this channel, you're able to get it right away in that case. So let's do that. So that is for the rate and what? Insurance. That's for the rate and then insurance in that case. So let's move on. Since there's no other question, let's move on to what? The trade debtors too. So the trade debtors too, going to open an account for it. So I'm gonna have my account for it as C, trade debtors. or debtors account, trade debtors or debtors account. So you have your T account for trade debtors. So you have your currencies here. So same format. You first of all check, is there any opening balances for that account that you are preparing? If it is yes, you enter those information in that case. So here you are dealing with what? Trade debtors. You are dealing with trade debtors. Realize that trade debtors for that's 1st October 20S5 as an opening balance was what? 18,000. So an opening balance was what? 18,000. Is that okay? Was 18,000. So that's going to be the open balance. Remember, trade debtors comes in where business, in this case, sell out any item to other party for which at that spot they won't pay for that amount that the business or the service that has been rendered by the business to other party. So at that point, since they will be given a first time to make payment, they will become what? A debtor to the business within that period. Until their payment is done, they are not what? Free. They become still a debtor or debtors to the business. That's why we had the trade debtors. So let's say I sell something to you. Let's say I'm A and I sell something towards you as what? B. And you didn't pay for it, and that's what I made the sales. You become what? My debtor. You own me. And that's what you become more like what? An asset to me. So because I know that they're going to pay money to me. And remember, the cash I'm going to receive is more like what? A current what? Asset. It's more like a current asset. And that's what going to be actually reflected. Is that okay? So trade debtors are basically what? Assets, but in this case they are what? Current assets. Going to be current assets because you said cash are what? Assets. Is that okay? I don't know, they're going to pay me cash and then they are going to record as what? An asset in my statement of what? Financial position. Is that okay? And other information related to it. So that is the opening balance of what? 18,000. We're going to record it. Since it's a data account, the opening balance of 18,000 is going to be at the debit side. Is that okay? Because an asset, current assets. So you're going to have your balance as what? Balance brought down as opening balance of what? 18,000. 18,000. I hope that is clear. 18,000. So once you get the 18,000 recorded, you check, was there any other information that transpired during the year? You deal with them. I think we also have what a closing balance. We'll get back to the closing balance once you are done with the information, other issues that transpired during the year. So let's see other information that transpired during the year. So far as trade debtors account is concerned. So we have what? One here, check received from trade debtors. That was what? 420,000 Ghana cedis. We also, the business also what? Gave them form of what? Particularly also gave them form of what? A discount. Discounts are given to reduce the indebtedness of what? Debtors. So we give you discount in order to reduce what? Your amount that you own, and also to encourage what? You as a debtor to pay what? Promptly. To pay what? Early or at prompt as and when you are due. Is that okay? So that's why we give what? A discount. So discounts are given to reduce the indebtedness of the debtor and as well to encourage debtors to pay promptly. That's pay on time. I hope that is clear. So that was given. And also, we also having what? A bad debt written off. At the end of the day, a business might render services to other parties for which they won't pay for it. But at the end of the day, some of them, it is estimated that not all the amount are going to what? Receive for the service that we rendered or the goods that we sold to other party for which he or she didn't pay on time at that spot. So if we estimated that this is going to be a bad debt, that's why business will make provision for it. But here it was just what? A bad debt. So at the end of the day, instead of you receiving certain amount from the debtors, some of them they didn't pay for it. So once they fail not to pay for it, that amount we need to write off from their books. It becomes what? A debt that the business actually didn't receive from the debtors. So that becomes a bad debt. And bad debts are basically what? Expenses. Bad debts are basically expense. And we said that all expenses have what? A debit balance. So when you go to bad debt account, it's going to be at the debit side. But since we are writing it off from two debtors account, it's going to be at the credit side. Because when debtors own us, it is at the debit side that shows that the owners. The debit side shows that the debtors own us. Is that okay? And when you write off some of what? The amount that the owners, that's going to be credited in the trade debtors account. And that of the discount, as we said, is given to reduce their indebtedness. So if it is given to reduce their indebtedness, it is an expense to the business, but then actually a form of discount toward the debtor to reduce indebtedness. So it's going to be at the credit side. Discount allowed going to be credited in trade debtors account so that it will reduce some of the amount that the trade debtors own Padisco Limited. Is that okay? So let's take note of that. And the check that we receive from trade debtors is going to be debited in that of what our cash book in a form of the bank account, right? So in a bank, and then you write it off from the trade debtors account as what credit, because it's going to reduce their indebtedness. So straight away, so here's going to what credited, here is going to credited, here is going to what credited. So once you get that issue, fine, you can easily record it and then you are good to go. I think that was all the information with regards to that transfer for the year. So we have what check receive. So check receive. So we're going to be in the form of what bank account that they paid for it, right? So that was what for 20,000. For 20,000, and then that of discount that we allowed to them to at the credit side is going to be what 13,000. So discount allowed, discount allowed, discount. Don't write this ALLD. No, that's the short way I'm doing, but then to speed up. But write everything in full. I hope that is clear. So discount allowed to, I think that was 13,000. That was 13,000. Discount allowed 13,000. Yes, and then bad debt of what 3,000. Bad debt too. So all these things are reduce the indebtedness of a debtor. So 3,000. So once you're able to record this information down, the next thing is, was there any closing balance for trade debtors? Yes, there was a closing balance of what? So at the end of the day, so we still have an amount that is still standing in trade debtors account that tells the business that so these people still own the business. For Padisco Limited, we have what certain people who still what owns them, and that was what 24,000. As I said earlier on, once you have any balance for a trade debtors, if that balance is actually an owing to another company, it becomes what an asset. But if that balance is at the credit side of the trade debtors account, that becomes an amount that the business owned. More like can be that the debtor has overpaid for it, or it can be that you have been given what a discount that actually has reduced indebtedness or any issue that may pops up. So when you have a debit balance in trade debtors account, it's what an asset to the business, but the credit is going to actually have other meanings to it, as I've already explained in that case. So let's see. So this 24,000 that you see here, it should be a balance brought down at the debit side of what the trade debtors, and you have other reflections at the opposite side. So we're gonna have here, sorry. So we're going to have here as your balance brought down as well 24,000. 24,000. I hope that is clear. So here we are closing the account. So you can clearly see that the credit side of the trade debtor is greater than the debit side. So by conversion, you should be able to see. So when I add the three values here, okay, here was what bad debt. Bad debt. Bad debt that we are writing it off. Is that okay? So when I added all the three, I had a total of 4,460. That's 460 what? 1,000. 460,000. Let's see if that is true. Is that true? Is that true? Let's see. Let's see if that is true. Okay, we have here. No, let me check. Let me check it well before I make any conclusion. Okay, okay, sorry. We should have had this one reflected. Come in. Come on. That of the balance brought down, you should have it reflection at the credit side of this, so that we add that one. So we're gonna have here to be balance brought down. So I've already added that in my head, but then forgetting to write it here. So that was going to the balance. So automatically you should have what 460 at the credit side. Is that okay? And debit side you're having 18,000. So the difference, remember, this is a trade debtors account. Trade debtors account, mostly information that's going to find the trade debtor account, part of them will be in the profit and loss, but others going to be in the statements of financial position. So always the difference between the debit side and the credit side, if sales is not given, it's always represented as what the credit sales for the year. So here the difference between the debit side of 460 and that of the 18,000 is going to be stand for what credit sales that the company made for the year. So it's going to work credit towards sales, not profit and loss. Trade debtors information doesn't go toward profit and loss. I mean, the balance doesn't go to profit and loss. Fine, this discount that we give going to go to profit and loss as an expense, bad debt profit and loss as well an expense. But then after computing or preparing trade account, the difference between, if sales is not given, the difference between the debit side and the credit side is going to what? Credit sales for the year. So let's take note of that. So here, gonna have here as what? Your sales, but then what? Credit sales, credit sales as what? So let's do the calculation, right? 460 minus 18. I had what? 442. So it's going to be what? 442,000. That's 442,000. That's going to be at the debit side as well. So at the end of the day, you close your account. Tell us that here she was 460,000. You close it, and likewise also do same here. So let me wait so that we can have some space for this. So here too, you're gonna have here to be what? 46000. Is that okay? So at the end of the day, the balance carried down here was carried down should be at the debit side as what? Balance what? Brought down as what? 24,000. 24,000, and then you are off and done. I believe that is clear. So that is that of what? The trade what? That's that of the trade debtors. So let's get back to the last one. That's called what? The stationary account, so that we are done for the day. So the stationary account. So let me have that one here. Stationary account. Stationary account opening is very big, so that we are good to go. So we have, so the same we're gonna do. You check whether we have any balances as an open balance in the books. You record it, and other information that transpired during the year, you also record that in that case. So let's see. Let's see. Let's see. So when it comes to stationery, we're having what? Stock in hand. That was the stuff, because stationery are basically pens, pencils that we use for administrative purposes in business. Is that okay? So you're gonna have an account for it, so that we record. So with the stationery, we're having stock in hand, and that was what? Thousands. That was the opening what? Stock. So you're going to record that one too as what? A balance brought down. Stock in hand, or stocks like pencil, pens, and these are what? Current assets whose benefits are within or enjoy within one accounting year, not exceeding one account, but or within what? One accounting year. And once we have that one, we're also having what? Amount that we own to our suppliers for station, and that was what? 900. So that's going to be also what? A balance, an open balance. And since it's owing, it's going to be at the credit side of our stationary account. As a liability that the business Padisco Limited need to settle in the future. So that's going to be at the credit side of what? Stationary account, as what? Balance brought down from previous year. And the stock in hand is going to be an asset, current asset, that's going to be at the debit side of what? Stationary account. So let's see. So you record it in that case. So you can say that balance brought down, that's the stock, right? She what? 1,000. And that of balance brought down at the credit side should be the amount that Padisco is owing to your suppliers so far as stationery is concerned. That was what? 900. You record it. And you ask yourself, was there another other information that transpired during the year so far as stationery account is concerned? So let's see. So we're having what? We're having payment to suppliers of stationery what? Account of what? 5,400. Of what? 5,400. 5,400. So the 5,400 was payment that Padisco Limited made to suppliers. So if the payment that we are making, so you're going to credit what? You're going to actually, since the payment they are making to our suppliers, and what means are we making the payment? So yeah, the means wasn't stated, but then once the means wasn't stated, the idea is that we pay with what? Cash, or the business operates with check. So automatically, so because you can clearly see that all the payment that you're making here was through check. So you're going to use what? The bank account. So bank account is going to be what? Credited, and then that of the supplier's account going to be what? Actually debited. Is that okay? So you're going to record it. You're going to record this So let's see how we record this: payment to suppliers of what? Stationery. And remember, the stationery is an expense. It's an expense. So we said all expenses have what? A debit balance. All expenses have a debit balance. So we're going to record it as what? A debit balance in the name of what? Bank account. So that's for stationery, right? So stationery here, gonna have here to be what? Your bank account in the name of what? Bank, because it's an expense. So going to be at the debit side, and that's going to have a figure of what? 5,000, 5,400. Is that okay? So once we are done, that is cool. Bank account you record, and you ask yourself, was there any other balances as closing balances for the year? Yes, there was a closing balance for stock. We are having 1,300, and for what amount that we still own our supplier was what? 600. So since stock is an asset, it's going to be a debit side as balance brought down, and then owing is going to be a balance brought down as what? The credit side of what? Stationery account, since the amount that we owe. So straight away we can come and record that one here as what? So let's say balance brought down as amount owing as what? 600, and then balance brought down as amount in terms of for stock on hand. That was what? 1,300. Let's see if that is right. 1,300. Let's see. Yeah, 1,300. So once you have that, you have their correspondence recording. So here you have balance brought down. You're gonna have here to be what? Balance carried down as what? 1,300. And here you're gonna have your balance carried down as what? 600. As 600. Or let me call it here. So let's have some space for it so that we can have the balances for it in that case. So with this, let's close the account and let's see which side is short so that we can find the difference to be what. Since stationery is an expense, the difference is going to be what? P and L. So let's see which side falls short. So we can clearly see that the debit side is more than the credit side. Looking at the figures here. So here 1,000 plus 5,400 going to give us what? Going to give us 6,400 plus 600 going to fetch us what? 7,000. So we're going to have the debit side to be 7,000. But the credit side, what is it? The credit side is you're going to have what? 2,200. I hope that is what we are getting for it. So when you take the difference between the two, you should be able to arrive at what? 4,800. So meaning that it was the credit side that was shorting. So the credit side that is shorting is going to be presented as what? Profit and loss account. It's an expense that's going to profit and loss account. Because stationery account, we say station is an expense. So since we have here the credit side in the name of P and L, when you go to profit and loss account, is going to be what? Debit side in the name of what? Stationery. And that should give us what? 4,800. So overall, you're gonna have a balance of what? 7,000 for each side. 7,000 for each side. And that is being recorded. And then you have your balances written down. So this balance is going to be a balance going to send it to the next accounting period. So 1,300. And then you're gonna have another balance, but down here to also to what? 600. And that is it. You are done. That is it. You are done. So this is actually how we record or we deal with what? Prepayments and that of accruals. Accruals and what? Prepayments. So let's take note of that. So if there is any other question, can let me know in the comment section so that I can respond to it in that. So that is all when it comes to accruals and so these are just the fundamental we need to understand so far as our double entry is concerned, because once the first of these principles, you're gonna struggle when it comes to the double entry in terms of recording. So let's take note of that. So thank you once again for joining today's section. It's been of great help coming your way to assist you and to provide you with the right tips. It can help you to actually pass your examination. So I'll see you in the next session where we talk about other issues in relation to financial accounting and other courses that we covered here. So for now, thanks for joining us. Bye bye.